This factory outside Istanbul is owned by Arçelik. The company is one of the largest suppliers of white goods to the European Union. After a contraction in exports last year, the company succeeded in growing its exports by almost 20% in the first half of 2010. That growth is due to a mild recovery in the company's traditional EU markets, but also to Arçelik's decision to explore new markets to the east.
Considering the growth opportunities in regions such as Middle East, Africa, Southeast Asia, and former CIS countries, we have identified those countries as priority growth areas.
Turkey's geographical position as a bridge between East and West provides Turkish companies with a unique opportunity, and the centre of gravity of Turkish trade appears to be shifting. While Arçelik's exports to Western Europe grew by just 3% this year, exports to the Middle East and Asia grew by 15 to 20%.
Turkey is very close to Middle Eastern Arab markets, to Iran, to Russia, to Central Asia, to the Caucasus, and to the Black Sea region. So Turkey is blessed with such a geography, and for that reason, with the relative political stability compared to its neighbors, Turkey is able to really dominate many of the markets in its neighborhood.
Markets like Iraq, where Turkish companies are dominating reconstruction efforts in the north. Iraq's risen from number 10 to number 5 among Turkey's export partners. Israel is another growth area. Despite political tensions, Turkey has increased its exports by almost 40% this year. Overall, Turkish exports grew by 18% in the first 7 months of 2010, ahead of the government's target.
Our target for 2010 is 111 billion annual export. We are expecting 15% increase our export this year. We are optimistic that we are going to realize 15%.
Largely as a result of this export-driven growth, the OECD has revised its forecast for Turkey's growth this year from 3.7 to 6.8%. Turkey's large domestic market has also been regaining strength, with consumer confidence rising and demand for consumer credit up 15%. The CEO of Turkey's second largest listed bank, Akbank, believes the country has weathered the financial crisis better than most due to lessons learned during Turkey's own financial crisis in 2001.
So the backbone of the economy is the financial sector. The financial sector was very strong, so has supported the real sector. So there is no any tendency right now in the market for deleveraging. And secondly, Turkish entrepreneurs, their attitude, their mentality is very flexible and very critical. So they immediately found out necessary export markets and tried to arrange their business. So due to that, the effects of the crisis were very limited.
But despite Turkey's strengths, its growth rate has averaged only around 3.3% over the last decade, far lower than competitors like China and India. Holding the country back is a poor level of education, especially compared to regional competitors.
Turkey ranks quite low when among its peers, for example, even in Europe, for example, when compared to Bulgaria and Romania. If you look at statistics and studies by the World Bank, by the United Nations.
Another issue is the poor engagement of half of the country's population. Turkey comes near the bottom of UN World Rankings when it comes to empowerment of women, education of women, and women in politics and business. Corruption is also a persistent issue.
There, Turkey has achieved some progress in the last 4 or 5 years, but that progress has pretty much come to a halt, and in some cases it has gone backwards. So unless Turkey improves its education system, its quality of its institutions, as well as empower women, then Turkey's growth rate is likely to be very, very restrained compared relative to its competitors.
These problems, coupled with fierce competition from China, meant that the Turkish economy was in fact in decline before the global recession hit in 2008. If the country is to continue on its current growth path, it must introduce further political and economic reform and diversify away from labour and capital-intensive export industries like textiles and cars, where competition from China is too intense.
We want to shift our export composite to the technology intensified sectors, and as a country we have two tools for this aim. We have a very good R&D law passed 2 years ago in the parliament, and now we are providing very good incentives for all companies, foreign or domestic, which have a good program for R&D projects. And also Turkey have special incentives for high-end technologies in 12 sectors. It will also help us in the future.
Turkey's transformation from capital and energy-intensive industries to high-value technological industries won't happen overnight. But Turkey can use its increasing geopolitical power over energy-hungry Europe to ease the transition. It lies between the major energy producers of the Middle East, Russia and the Caucasus, and major energy markets in Europe and the West. The Baku-Tbilisi-Jayan pipeline, which opened in 2006, transports oil from Baku in Azerbaijan to the Turkish port of Jayan, and from there on to Western markets. And several gas pipelines are under consideration to move Central Asian gas to Europe via Turkey, which would avoid dependence on Russia. Which means Turkey's main trading partners in Europe will not be looking to upset Turkey for the foreseeable future. Whether or not Turkey reaches its target of growing exports from just over $100 billion today to $500 billion by the 100th anniversary of their republic in 2023, Turkey's growing importance on the world stage will continue to make its economy one to watch in the years ahead.